Welcome, everyone. We are delighted to be here. Thank you for joining us for what I think is really going to be a terrific webinar on reimagining regulation in the digital asset world. And today we're going to be focusing on self-regulation, which this panel thinks is going to be kind of a critical element of regulating digital assets. And we almost missed the start of this webinar. We were having so much fun. So we are, you're going to really enjoy this because I know we are. It's a great panel with a lot of people with just the kind of experience that's important to a topic like this. Suzanne Elovic is the president and head of partnerships at Parallel Markets. She has a deep understanding of compliance challenges and has seen issues from all perspectives. She was a regulator in FINRA's enforcement division where we worked together, I must say, a senior level compliance professional at UBS, the chief legal compliance officer at Carta, a really fast growing, fascinating fintech startup, and now is president of Parallel Markets. Gabriella Kusz serves as the CEO of the Global Digital Asset and Cryptocurrency Association, which is now a global voluntary self-regulatory association for the industry. Her background has included working in international finance and economic growth, including working with the World Bank Group governance global practice. She's an emerging leader with the Chicago Council of Global Affairs, a fellow of the Digital Euro Association, and appointed Speaker of the U.S. State of Arizona House of Representatives to lend her knowledge to the state's Blockchain and Cryptocurrency Study Committee. Last but certainly not least is Caitlin Barnett. She's the Director of Regulation and Compliance at Chainalysis, one of the leading blockchain analytics companies. Her legal and compliance experience encompasses both cryptocurrency and traditional finance, which I think is very important to digital asset regulation. And as Director of Regulation and Compliance at Chainalysis, she helps leading financial institutions strategize and build compliance program to adopt cryptocurrencies and offer new products to their customers. I'm Alma Angotti. I'm a partner at in financial services at Guidehouse. Like Suzanne, I was spent time at FINRA actually creating the AML compliance program for broker dealers at the NASD. Which then became FINRA. I'm a lawyer by training. I was at the SEC in enforcement for many years. I went to FinCEN to create the enforcement program for the Bank Secrecy Act in 1998, and then went from FinCEN to FINRA, and I've been a consultant working with a lot of fintechs and digital asset companies here at Guidehouse. So as you can see, this is a group that has a lot of experience in thinking and dealing with these issues. So we're just going to spend 10 seconds talking about the cryptocurrency global adoption rate and why that's important. So you can see that the global index score by quarter has just skyrocketed. Next slide. And the adoption of cryptocurrency is mimicking the rise of the internet back in the 90s, which we think is really interesting. Gabby, did you want to talk a little bit about the state of regulation now and why, which kind of sets us up for talking about why an SRO is going to be next, really important. Next slide. There you go.
So, I kind of wanted to talk a little bit about, what we're seeing happen. And I think sometimes when we look at, why there's been so many challenges with shoehorning into current legal and regulatory structure, it's important to recognize that what's actually happening is a fundamental financial sector and economic transformation. And so in this space, you're seeing all countries pretty much all at the same time trying to grapple with how to regulate this, and in many ways, how to reimagine what it means to regulate in order to ensure that they're able to fulfill their mandates, usually around two core areas: market integrity and consumer protection, and then also to try to advance economic growth and development for their home countries and jurisdictions. So I think, it's in that space that you're seeing certain countries kind of take a lead. Some are looking to advance more nimble, flexible legal and regulatory structures that allow for longer term growth and evolution. And so you're seeing a lot of countries look to adopt self-regulatory models. So looking at countries like Switzerland or Japan, or, some of the emerging efforts in South Korea, this is sort of the understanding that there needs to be something that allows for the industry to develop and grow, but still to retain a high degree of regulatory coverage.
So that's a great summary, Gabby. Caitlin, you've had the interesting experience of working and being the chief compliance officer at a cryptocurrency exchange with a lot of regulatory uncertainty. How has that affected your thinking about possible structure around how these things should be regulated?
Yeah. So, along the lines of what Gabby said around regulation, you're constantly hearing this term, regulatory clarity, coming out of the industry, right? That's what everyone is really looking for. I would say the majority of the industry wants to be compliant, is looking for that guidance. But we want to make sure that proposed regulatory frameworks are feasible, because this technology is changing rapidly, and we're typically seeing old regulatory frameworks being applied to this new technology. So, the possibility for an SRO, and we've seen this kind of attempted by the industry a few different times, and maybe it hasn't taken off because of the maturity of the industry, but I think we are getting way more mature very quickly, just as everything else in this industry is happening. If we can come together and, come up with best practices, which is what we've really done as an industry so far, if there's not a specific regulatory regime that we can point to, we're taking the closest fit and trying to apply it so that we can be compliant in nature. But overall, I guess the main thing I would just point to, from being in the industry and now being at Chainalysis, dealing with a whole host of industry participants from traditional financial institutions, centralized exchanges, at DeFi now, everyone is looking for that regulatory clarity and wants to be compliant.
And to that point, these are some, but not all, of the federal regulatory agencies that sort of have or want a piece of the regulatory scheme. And then there's the sort of steel cage match going on between the SEC and the CFTC about who's going to be the primary federal regulator in this space, which has a lot of implications for the industry because they're not terribly different regulatory regimes, but somewhat different. Suzanne, I'll let you talk about that in a minute. I just want to go through the next slide, and then you have this sort of not second tier, but second level regulatory bodies like FINRA, which is the SRO for broker dealers. So if a cryptocurrency is in fact a security, then technically you have to register with FINRA to trade it. Then you have all of the various state regulators for global companies. You have the European Union, which I think just yesterday finalized their MiCA framework for digital assets. And then the guidance from the Financial Action Task Force, the Bank of International Settlements, IOSCO. There's a lot of different input into the framework. So I think firms can get close to what might happen to them, but they can't be sure of it. And then we have the recent, in the next slide, the president's executive order from March with another one in September of this year that is on the next slide that just basically lays out, Gabby, what you said, the sort of primary regulatory considerations, which are true in some form or another globally: consumer protection, financial stability, financial crime, and enabling innovation. Suzanne, do you want to talk about that for a minute?
Yeah, I think, first of all, it's important to say, and I think everyone's already touched on it to some extent, but the the way in which the adoption of crypto is going to continue on the trajectory that it's on is by developing the regulatory scheme. And I think the challenge is figuring out not only who should own it, but what it should look like. And one of the real challenges is, I think with every innovation we've seen in financial services, each one keeps being faster than the next, and regulators really struggle to keep up. And so I think for those of us who are engaged in the space in a way where we're intending to do things that either in some instances replicate from a principles perspective the types of regulatory controls that are already imposed in more sort of traditional finance, trying to figure out like what does that look like, and how will that innovation eventually blend with regulatory concerns is certainly like the work that all of us are engaged in all the time. Parallel chain analysis and Gabby's organization, the DCA, like we're all trying to do that, right? And so when we think about, well, what should the regulatory scheme look like? So for example, who should own it? There's probably some predisposals to like certain organizations that have already dipped their toe in the water in the space. And yet at the same time, I think we don't want to limit our thinking in, well, it goes to the CFTC if we ultimately determine it's some type of commodity. It goes to the SEC if it's a security. Because I think what we'll see is a desire to design or structure products in ways to elude whatever regulatory scheme pre-existed. And so the key, I think, is going to be to develop, and it will either be an expansion of rules under one or both of those existing organizations, or perhaps even some new body, although I think that's really hard to imagine in the current regulatory climate or legislative climate. But I think the really interesting question is going to be figure out ways to avoid getting tied down with things like, well, it's a security, or it's a future, or it's a commodity, and therefore pound the square peg into the round hole of existing regulation, and instead be looking for opportunities to adapt and make more flexible the regulatory scheme to accommodate what we really want to be fast and innovative thinking and development in the space. So I just want to sort of put that out there as a framework. And then, certainly like what Parallel is doing, which is very focused on identity, right? So everybody talks about crypto as, the most important feature of crypto is anonymity. And first of all, I would beg to differ. I think that what's important about crypto and blockchain more generally is the self-sovereignty, the ability to control your identity and where your information goes, less so to actually be anonymous. And I think the real players in the space, the ones who are going to drive adoption, the ones who are going to drive all the capital into the space, are less focused on anonymity than they are on the other features of blockchain, which could afford anonymity, but that's almost a symptom rather than the root. And so I think there are ways to develop identity that preserve the control and sovereignty over your identity without necessarily meaning that nobody gets to know who you are, and therefore you get to engage in criminal activity and nobody can find you, right? So that's the balance that we're really trying to get right, where you don't get to elude detection by participating in the crypto universe, but you do get to hold on to these critical features of blockchain, which really are about sovereignty of identity, peer-to-peer transactions, and those are things that we think we can absolutely afford with like the right regulation and the right innovation. Have to say, Parallel being at the forefront of that, as is chain analysis. And so, I think these are, in my view, this is really where the regulatory scheme is going to go. Is can we know who the participants to a transaction are, and then can we trace the transaction all the way through? And those are sort of the two cornerstones that chain analysis and Parallel hold up. So
well, and Caitlin, I'm sure you'd like to talk about the fact that they're really not, crypto assets are not really as anonymous as people like to think they are, because even though, you can learn a lot about a wallet by the transactions that come and go out of it. So while there might be special risks, there are also very special mitigants.
Yeah, absolutely.
Yeah.
I always like to talk about, I think there are two gut reactions when people start to get into crypto and see blockchain analytics for the first time. I know I had a very strong reaction. I think there are people who are amazed and are like, oh my God, I can see exactly where these funds are coming from and where they're going to, and I can just put a stop to it, and I can file a SAR without having to, do Googling and try to figure out, is Caitlin Barnett LLC, a shell company engaged in shady business, or, what is she actually trying to do? And then there are people who are like, oh, I don't want to see this. I don't want to see the bad stuff that's happening because this is really scary. And then you get into that talk of dirty crypto and tainted crypto, where we all know that dollars are just as dirty, if not dirtier, than crypto is. But because of the historic, negative connotation associated with cryptocurrency, all you originally heard of was darknet market, money laundering. Unfortunately, that's all you kind of, it's making the news headlines. But my gut reaction when I saw blockchain analytics, I was like, oh, this is not anonymous at all. Like, you can very clearly see where this is going to, where it's coming from. Even some of these anonymous, assets that are coming out, Chainalysis is able to provide those real world identities. So just quickly, for those on the call who might not know what Chainalysis is and what we do, we're essentially, I love this analogy, we're like a phone book for cryptocurrency. So we're providing those real world identities to the blockchain. So instead of you seeing a bunch of alphanumeric mumbo jumbo, these long strings, we're telling you it's coming from Gemini. We're telling you it's going to a mixer. We're telling you it's coming from a darknet market. And so as a compliance professional, you can very easily say, nope, I do not want to interact with this. I'm going to close that account, file a SAR, move on. Or, yep, this is within my risk tolerance, good to go, and move on from there. But yeah, I do love this idea. And a lot of my friends and family, when they hear what I do, which I don't tell people very often because it's just not worth getting into the conversation unless there's a lot of alcohol around to make it a little bit easier. They're constantly like, yeah, well, it's just used for money laundering. And I'm like, no, it's really not. Like, it's absolutely not. But I don't have my laptop with me at all times to bust out the Chainalysis, tools and presentation.
So that raises, Suzanne, your point and Caitlin's point. We're getting some questions in, and I want to take them at a good time. But the question about privacy and traceability, there's a question from the audience about about central bank digital currencies, which, as people probably know, but just in case you don't, there are projects going on all over the world to actually put full faith and credit backed currencies on the blockchain. And somebody has asked, what's our opinion about CBDC and stablecoins in the US? Who's leading? How far are we from launching? And some other really good questions. And I do think, and I'll be interested, I'd like all of you guys to address that, but I do think one of the big, at least in my conversations with people at the Digital Dollar Project, one of the big policy issues is just that, Suzanne, is privacy for, you can say, look, if you buy Bitcoin, you've bought into a publicly visible blockchain, right? So whatever you can see from, it's like getting on the bus. People see you get on the bus. They know you got on that bus. But with an official CBDC, it won't be optional if you want to use that currency. And so I know that there's a lot of technology work going on to keep the privacy of those transactions, but allowing the traceability. For example, there is a fully used digital yuan in China, but it's completely visible to the Chinese government. And that is not the kind of thing that most Western democracies are going to be comfortable with. I mean, Gabby, you've been talking about these issues a lot. You might want to start us off here.
Sure. So I think the question of a CBDC, this has to reflect some of the economic, social, political context of any given country. And when we look at, what are some of the key characteristics that would cause or create like a solid foundation for a CBDC in the US, we're looking at first and foremost interoperability. You're looking at privacy. You're looking at security. You're looking at technological sophistication. And these core components have to, I think, be in place because unlike other countries where, it's a state command control, they can push down regardless as to whether or not the technology is sophisticated, whether or not privacy concerns have been respected. In a democratic society, there obviously will be a need to balance these different types of factors and to ensure that, citizens are protected and that, to the degree that it's able, especially when you have an open market system, and that CBDC would likely be competing against other types of stablecoins or other types of crypto in some factor form, that it needs to be technologically sophisticated in order to have uptake. Right. So if you're looking at countries like Nigeria that have adopted the e-naira alongside other types of, crypto or digital assets, you'll notice that some of the adoption has been slow, in part because of the lack of interoperability, the need to download a specific government wallet to hold that CBDC. And then also the fact that, again, there's this concern around a high degree of transparency with regards to every single transaction, no matter how large or how small. So I think that, there needs to be sufficient reflection and consideration in terms of, where we're at today. If you look at some of the evolution of the stablecoin market, for example, we have a number of private sector-led and developed stablecoins that have come forward with robust, sophisticated technology that seamlessly interact and engage, with different wallets and are able to be transferred and exchanged relatively easily. Now, again, to the degree to which you believe that's easy, it may be dependent on to what degree you're digitally native. But I think some of that should not be underestimated. I think, too, when you're looking at, a CBDC, you have to reflect and consider what is the impact or the solution that it's trying to solve for, right? So I think there are some aspects of this that if you're looking at geopolitical prominence, if you're looking at, national security, I think these pieces, there are some elements of this that can be carried forward with regards to the current and existing stablecoins that are backed by high quality assets. And that are audited on a regular basis and that have, certain risk modeling components involved in their development and design. But I think that, ultimately, do I believe CBDCs are a competitor to stablecoins? No, I think that they're complementary in many cases. And I believe that there is a world where harmoniously CBDCs, crypto stablecoins can exist. I think the degree, though, to which a CBDC is successful in that world will be based upon, especially in a democratic society, the degree to which it embodies those characteristics that I just previously laid out.
And just to answer the specific question, because I just reminded myself, in the most recent executive order in September, there is going to be more discussion and around the development of a U.S. central bank digital currency. And in fact, the Boston Fed, in connection with Circle, is sort of exploring those options from a technology standpoint. And we just noted today that SWIFT has come up with what they said is a trial hub for transmitting central bank digital currency as well as other tokenized assets. So there's a lot going on. I think we're kind of pretty far from anything getting sent to your wallet. Suzanne and Caitlin, I'm sure you have an opinion on this as well.
You want to go ahead, Caitlin?
Sure. I think Alma and Gabby summed it up really nicely already in terms of where we're at on this. There are a lot of positive aspects of CBDCs. I just think we're, to Alma and Gabby's point, we're probably far away, but similar to, the benefits we've talked about, cryptocurrency in general, combating money laundering and financial crime would be amazing if we went towards CBDCs as well, because you would be able to track and trace where, you can say what you want about the illegitimate uses of cryptocurrency, but cash will always be king. And, once you withdraw that cash and get it out of the financial markets, you can't trace it anymore. And the investigations typically stop. So, from a money laundering perspective, moving to CBDCs would be an amazing thing for law enforcement.
Yeah, I completely agree, and I think the privacy concerns are real, and look, I think it's going to be really interesting to see in the end if all of these sort of different ideas end up coexisting. And to your point, are they complementary or do they compete? Does one kind of squash out the other? And I think the interesting part of that is if you don't have any confidence in your ability to maintain your privacy in those different types of products, you're not going to use them. And so I think in some way market forces here will win out. And one would hope that that the way these things would be deployed would be sensitive to those concerns, which I think are really, as I've said, like kind of the underpinning for what's so exciting about blockchain is the ability, on the one hand, as Caitlin said, where you can certainly see scenarios where our effectiveness from an anti-money laundering and fraud prevention perspective actually significantly go up within these schemes from where they are today. I mean, in traditional finance, we're spending billions and billions of dollars on AML compliance, but we're not that good at it. And I don't just mean like the processes aren't good enough and all the firms get fined, which of course is also happening. But even to the extent that we're deploying sort of the most effective tools and programs that we can come up with, we're still not catching the vast majority of money that's being laundered and going through criminal proceeds. And so I think it's really exciting to be thinking about some of these technologies as actually being able to foster more effective fraud identification and money laundering identification, while at the same time promoting and protecting privacy in ways that you really can't in traditional finance.
This is all great. And as you ladies and gentlemen in the audience can tell, we could talk about this like for hours and have at many times in the past. But let's talk to specifically about SROs. Gabby, why don't you start? What do you see? What does the global DCA envision as far as what assets should be covered? Would NFTs be covered? What about DeFi? What about unhosted wallets? What should the SRO framework look like? And then we'll
get into it.
Yes.
Yeah. So I think, it's a really good question. And I think at this point, we are engaging in a number of different policy roundtables to try to draw industry in to ensure that we're reflecting what their believed desires or needs are in the market. So to date, we've gone through about 60 individual one-on-one interviews. We've completed our first roundtable. We'll be doing a second, and depending on the outcomes of that, we may even, move forward with a third. But, to date, pretty much everybody, when you ask, like, again, what should this SRO do? That question is really hard to answer. But if you start it from a point of what are the pain points that you feel as a firm, what are those areas that lack clarity? And then you move down to what are the things that would need to be solved by like formal government regulation or that you believe could be solved by that. And then what would need to be resolved by something that is far more flexible, nimble, and responsive to a currently evolving industry area. You come up with like a pretty sound description of sort of 4 core areas. And the first of that is very much around taxonomy. So having the ability to almost act as a first point catch-all as new products and services come into the space, to be able to help to differentiate, almost like I kind of joke, I have small children. So the Harry Potter like sorting hat, right? That kind of decides, which house it kind of belongs in. And so that's sort of a first step. And then being able to support and provide insight with regards to stablecoins and payment tokens, because this continues to be an important component that we see stepping forward with regards to the evolution of the DeFi space. And then finally around custody. So once these pieces get resolved, then the question becomes, well, what happens as we continue to evolve and grow and new and different products that perhaps we haven't even imagined yet come forward? And that's where I think we look at sort of a, how would you orient or organize a whole of industry when you don't even know what that whole of industry may look like in 6 months or in a year? And that's where you start to realize that you need to have almost like a narrow band of mandated participation. So that would likely be, things like centralized digital asset exchanges and, VASPs. And then you would start to kind of branch out and say, well, if that's the piece that would be, mandated participation and, oversight, then what do we do with the bulk of this? And how do we ensure that the voice of those participants are included in some of those taxonomy decisions? And how do you ensure that your orientation is truly anchored in both the financial sector, the further economy, and sort of the global sphere? And that's where, having this kind of other component that allows for voluntary participation, perhaps more as like a voluntary mechanism as opposed to like a mandated mechanism, really comes into play so that you fall under the broad umbrella of that SRO and you're allowed to have voice and representation for your industry vertical, but that we generally recognize that there needs to be sort of a right-sized regulatory approach where we're really only overseeing or directly regulating those aspects of the ecosystem that represent significant risk, that, very much strongly tie into the concepts of consumer protection and market integrity, and that very gently and naturally lend itself towards a build and a constructive approach. So that balance would maybe focus more on guidance, okay, and building systems right the first time. So talking about capacity building and internal systems, processes, policies, and operations that would lend itself towards a healthy and resilient industry that could stand forward globally. So I think that that's sort of what we look at when we see, how and what entities would be, I think, a first sort of focus of mandatory participation, and those that would fall under more of a voluntary umbrella that would allow for that flexibility, evolution, and growth of the industry, but do it in a constructive and pragmatic way.
Suzanne, having worked at both the New York Stock Exchange and FINRA, what elements of that SRO regime do you think would be good for this industry? Which ones do you think we should stay away from? How can we use your experience to make this iteration better?
Well, when we were at FINRA, it was perfect, but now.
Of course, and it's all because we moved on, Suzanne.
Exactly. No, in all seriousness, look, I think part of what you have to think about when you're thinking about a self-regulatory organization is maturation and evolution, right? So what it could be 10 years from now versus what it should be on day one, I think are two very different things. And so, for example, an enforcement arm is probably not the first priority for an SRO in a very evolving industry where, we still don't know what the rules are, right? So trying to enforce rules before you have rules is a good way to get, the industry to hate you before you even started. So, I come from enforcement. I'm a big believer in enforcement, but that is definitely not where one starts. The other thing I would say that I think sometimes is missed because, an SRO like FINRA has been around for such a long time, as have, some of the other big ones in the financial services industry and certainly the securities industry, is, people lose sight that it's not intended and in many instances is not actually an adversarial relationship and is much more of a cooperative one. And so for me, I think the best elements of FINRA when I was there and since and before and hopefully forever is, all of the engagement around the membership and really hearing, having an avenue to hear their concerns, how, what they're seeing, what the issues are, new products, and being able to vet those and talk those through before they're launched. That's the kind of thing where I think an SRO can be incredibly valuable because it can marshal a lot of information from a larger industry than maybe any one company would have access to. And, I'm constantly amazed at the way in which this ecosystem around crypto is coming up, and there is a tremendous amount of discussion and collaboration and sharing already. But I think an SRO can really help formalize that and really help everybody understand and get best practices from each other. And so, especially in a place where the rule book isn't written yet, and there's going to have to be a lot of time, energy, and effort, and probably years spent doing that. The first step for me is really making sure that you get the type of collaboration and information that an SRO can uniquely provide, and that I think in some instances, even today, FINRA is especially capable and adept at doing. And then the other thing that I think sometimes, in order for an SRO to have any teeth, even without an enforcement organization, I do think an exam program is extremely valuable. Having said that, I think there's a bit of perception, some of it fair, some of it probably not, that a lot of this exam function and for many of the regulators is kind of check the box to really be avoided here. And it's easy to avoid because you don't have the rules that you have to check off yet. There will be some obviously, but I think that to let an exam program almost inform the rule book as opposed to the other way around in the early stages, I think could be really valuable. And I think the ideal, I mean, Gabby's doing a phenomenal job in building something that really could one day be the SRO for the crypto industry. But I think the really exciting part will be taking both ideas and practices that have worked well for evolving industries from existing SROs, as well as probably even some personnel from those places, and then really wedding that with the sort of the newcomers and the innovation. I mean, there's a lot of people working in the crypto space who have never before worked in financial services, and that is terrifying if you come from my background, but also just absolutely inspiring and exciting because they're not sort of handcuffed by all of the perceptions and understandings that they have from traditional finance. And so I think trying to blend that experience and that creative thinking will be really valuable in coming up with the scheme that works better than the last one.
Caitlin, what would have helped you the most when you were building, helping build Gemini into the exchange it is now in an area of even less regulatory certainty than we have now? What would have helped you in an SRO context?
Yeah, a lot of what's been talked about, right? The collaboration would have been key because I'm not going to say we were making it up as we were going along, but a little bit. When there is no clear framework, you have to rely on what you've seen in the past and try to apply, whatever is closest to what you're doing. But this technology was so new, and it was really difficult in the early days. And I think what was just talked about is so key. The maturity, the lack of traditional financial institution players in the crypto market. So, I'd go in the room and I'd be like, okay, we got to do KYC. We have to do this. And they'd be like, wait a minute, what? And it's like, no. Like, this is basic stuff that you have to do. But when you didn't have traditional financial people there, that was, you're talking to all engineers. They don't understand compliance. So it was brand new. But then the industry was and is still, I don't think as much, but very, very competitive. When I was at Gemini, we were launching the Gemini dollar and we were waiting for DFS to give us approval. And, DFS was also looking at Paxos dollar and we got approval on the same day. So I think that's a reason that a lot of the exchanges, the older exchanges, were really hesitant to come together as an industry in the early days because you didn't want to give up your trade secrets, right? And so you were working on these new products, but you didn't want to tell anyone about the new product because you didn't want them to steal it. So it was a very cyclical action. But I think now the industry has matured way more. And this collaboration piece would be key. Like, it would have been so nice to be able to go to someone else and be like, how are you handling this? Like, what are you doing? Is there anything different? And be able to have that open line of communication.
Oh, I hadn't even thought about that early competition, but you're exactly right. And in that regard, Gabby, since there are look, a lot of the crypto products that are out there look a lot like the old ones, right? Debit cards, credit cards, different sort of things. But are there sort of technology, crypto and digital asset technology specific considerations that you think that an SRO for this industry really needs to focus on, that makes it different from stocks and money and other kinds of self-regulatory organization?
Sure. So I think just the use and leverage of blockchain technology, the transparency that you're able to receive in regards to, monitoring and oversight, I think these are pieces that I would say lend themselves to sort of a new way of viewing how you could potentially regulate, or I even say sometimes I put in quotations like inspect, because it may not be the same way that you would interact, and it may not be as invasive or as burdensome. Because to be quite honest with you, if I have real-time information coming in at all times on every transaction instantaneously, to what degree do I need to do sort of this old school audit-esque experience? And how could I reduce some of the emphasis or potential burden that places, especially on small and medium enterprises, when it comes to ensuring that I'm fulfilling those ultimate impacts? I think sometimes it's a great way to almost reverse engineer, starting from a standpoint of what you're trying to achieve as a regulator or as a self-regulatory organization. If our ultimate, impact that we're trying to achieve is consumer protection and market integrity, then let's walk that back and really look at it through the lens of how transactions are undertaken with this technology, and in what ways can we leverage and actually amplify some of the very positive elements. So, a lot of what we see, especially in DeFi and in crypto, are very strong, cohesed communities that in many instances can act almost as like community policing. These are elements that you could raise up or bubble up in order to ensure that there are certain buffers. I think, looking at not only the technology itself, but like some of the cultural aspects of this are going to be very important to creating that regulatory coverage. I think if we're looking at like down the line, you're looking at, the DeFi movements, and not everything may require a policy intervention. It may, in fact, be a technological evolution that solves some of the challenges that you see around AML KYC. We have parallel markets that talks about digital identity. I think a lot of times when we talk about the question of privacy, it's actually less of a policy issue and more of a need for technological advancement and also alternatives to what we've seen in previously when we look at TradFi and the ways that we've AML KYC'd. I think, there's so many different opportunities, and it will take a very open-minded approach to creating something that's uniquely tailored towards a lot of these, I think, very exciting and dynamic shifts that we're seeing, in this space. And so although there are things that may, upon first look, have an initial appearance of some of what we've seen in TradFi, the reality is that once you dig a little bit deeper, you understand that in many cases, they lend themselves more effectively to more efficient, effective, and expedient regulatory oversight. And so that's the thing that I would like to bubble up and ensure that we really deep dive and explore, so that you're able to really create that system that works for everybody and protects and ensures, safety, security, and privacy.
And I just want to tell the people in our audience, I will get to your questions. I'm going to save some time at the end for that, because there are some good ones here. But that leads into a really great topic. So Caitlin and then Suzanne, respond. Technology is the problem and technology is the solution, right?
It's true. Technology is the problem in terms of how quickly the technology is moving. And, we've said it a bunch of times throughout this presentation, regulators can't keep up. It's difficult to regulate in an efficient and comprehensive and thoughtful manner with the speed of this technology. Now, on the other hand, the technology is totally the solution, because with, blockchain analytics specifically, obviously I'm a little biased with my work at Chainalysis, but I'm amazed at the work that we've been able to do on both the public and private sector side. I came traditionally from the private sector side in both traditional finance and cryptocurrency. But now being at Chainalysis, I've gotten to work really closely with our public sector side as well. And, we're working really closely with regulators all over the world to help them think about how they should regulate this new ever-evolving technology. So it's true. It's the problem, but it's also the solution.
Suzanne, I'm sure you agree with that too. Yeah.
Yeah, no, I definitely agree with that. And look, I think, first of all, what Chainalysis can do is pretty amazing. So, it just goes to show, right? Like, I think as these concepts and products evolve, it is hard to stay up. And I think regulators will be challenged. They're not known for being able to move quite as fast or evolve their processes in effective ways quickly. But I think what we'll see is that regulators will also learn to evolve faster with the way technology has evolved. But look, on the parallel side, I think the way we're looking at it is, there's a lot of ideas out there when it comes to the way in which these different transactions will go down. But there's some very basic concepts around privacy and control of your own identity that absolutely can be solved with the right type of technology. And that, again, I'm a little biased too, but that is absolutely what we're trying to build is a way for people to interact on the blockchain completely anonymously to each other, but still with levels of security, transparency, and certainty that the people that or the entities that they're interacting with, or even the wallets that they're interacting with on the other side, have somehow been checked, and that they feel confident that these are legitimate parties for them to be interacting with, both from a sanctions perspective, from a fraud perspective, and then just from a legitimacy in terms of they actually have the capital behind them that they represent that they do. So I think these are new ways, like KYC will have to be completely reimagined, I think, in a crypto world. It will not look the way it looks today. But I think these are absolutely things that technology can solve. I'm known for saying that KYC is more of an art than a science, and that there will always be elements to it that are manual. I hope I'm wrong about that. I like to think about it in ways where actually the whole thing could be automated. I'm not sure we'll ever quite get that far, but I'm very confident that there's a lot more about KYC that can be automated today, and I think building it within the ecosystem of crypto is exactly the way it needs to be done. So yeah, I'm really excited about where the technology is going, and I think the way we do financial transactions 10 years from now is going to look so completely different than even what we're imagining at this moment.
Let's get to some of the questions, because people were have some really good ones here. One of them is kind of practical, and it shows, I think, the different kinds of SROs that you can have out there. But Gabby, somebody asked, will the global DCA SRO framework restrict digital assets to the institution alone, like electronic market makers, or will they have other options? And I think the point here is this SRO would regulate or self-regulate the participants and not the tokens. They could trade anywhere, correct?
Yeah. So, that's a good question, because it, calls into question the degree to which you would aim or design a regulatory system to be focused on a product versus a firm. And I think in this instance, it's better oriented at the firm level. So I think that there would need to likely be some level of requirement around disclosure. You would then have a certain degree of systems compliance and alignment, which would be targeted at a firm level. And then one of the key pieces that we've been speaking about in particular particular, in order to ensure that there would be no undue harm, would be around some form of restitution. So looking at the potential for utilization or inclusion of some level of an insurance product. So looking at potentials around similar to what you've seen with SIPC or some form of commercial insurance product. How would you, even if you had the disclosures on level 1 and you have now worked with firms on level 2 to kind of build out compliance systems, then, especially for those types of very new edgy products and services that would be entering the marketplace, could there be some form of, restitution that could be provided in the event that even those 2 first levels, failed? And I think that that's sort of the piece that we are discussing. And there has been a lot of back and forth, potentially around the pros and cons. But I think it's a really good question. But I think, given both, most effective and efficient use of resources, appropriateness of targeting, and then the nature and evolution of the industry as a whole, it is best prioritized in terms of design at a firm level.
Caitlin, somebody has a question about what we think about mixers and tumblers, and especially in the context of Tornado Cash, that's a very timely question.
It is. So it's interesting, right? I think before the designation of Tornado Cash, we were seeing a trend where OFAC in particular was paying more attention to mixers and tumblers. It was a pretty clear indicator that if you weren't paying attention to mixers and tumblers and how your platform is interacting with them, you probably should. Now, the mixers and tumblers who were designated prior to Tornado Cash were actual entities run by real human beings. Tornado Cash is a protocol that's not run by human beings. So this is the first time that we've seen this designation, and that's why you've kind of seen this uproar from the cryptocurrency community. And it did make such a huge impact that OFAC actually provided guidance on this designation, which we don't typically see OFAC coming out so quickly with guidance on how to handle those designations.
Could you explain to folks what mixers and tumblers are? It just occurred to me, everyone, I don't know who's in the audience, somebody might not really understand what we're talking about.
Yeah,
probably
absolutely.
They do. So I apologize if everybody knows this. But.
No, it's a really good point, Alma. When you live and breathe it, you kind of forget.
Exactly. We forget.
So mixers or tumblers, they are basically, you can use it where you can put your cryptocurrency in, it mixes up, it tumbles around, and it spits back out from a different wallet so that you break the chain of custody, essentially. So it becomes very difficult for you to follow the chain of ownership. And so you can use it for a couple different reasons. The cryptocurrency industry is very privacy conscious. So a lot of people truly do use it just for that. They don't want people knowing, what they're doing and where their funds are coming to or going from. But then there are also nefarious uses for it, and people do use it to clean funds. So they would potentially withdraw funds from a darknet market, deposit them into a tumbler, and then from the tumbler, deposit them into a custodial account at, a centralized exchange. And at that point, the exchange could only see that it's coming from a mixer or a tumbler and not from the darknet market. Most exchanges have, changed their policies, made sure that if they are interacting with mixers, they're questioning those customers. They're trying to understand their risk profile. What's the use case? Unfortunately, now, though, due to the recent designations, I think people are very hesitant to allow any interactions with mixers. So very curious to see where this is going to go in the next couple of months and years, because there are still a lot of mixers out there. With the evolution of DeFi as well, though, I'm not sure exactly how we're going to thoughtfully regulate this industry.
That's very important. One more question for you, Caitlin. Excluding privacy tokens, what differentiates a high-risk cryptocurrency from a low-risk cryptocurrency? And my initial thought is it probably deals more with who's trading it than the actual digital asset itself, but you may have a different view on that.
No, I really liked this question because there is no answer, right? When it comes to risk in this industry in general, it's your own risk tolerance, right? So what we have seen in the industry at large, and when I was at the exchanges, a lot of the exchanges have come up with what's called a digital asset listing framework policy. It's a mouthful. And what this does, the New York Department of Financial Services essentially had greenlit a bunch of assets that exchanges could list without having to get approval from the regulator. But then what they also allowed a lot of the industry participants to do is to come up with this policy and have it approved by DFS so that exchanges could then do their own assessment and list assets without waiting for regulatory approval. And that's how these exchanges are determining what's low risk, what's medium risk, what's high risk. And I would say a big piece of that is the legal analysis to determine whether or not something is or is not a security, which we could probably talk about for hours upon hours. So I won't go too far down that rabbit hole. But that's one major consideration. The market cap is another one, making sure that there's not a ton of volatility around it because that can cause issues on your platform. But there's a whole host of different issues that go into low versus medium versus high risk that, again, I think goes back to your individual exchange's risk appetite rather than just blanketly saying Bitcoin is good, Ether is bad, Zcash is good, so on and so forth.
We're almost at the end, so I'm going to give everybody kind of a final 2 seconds to talk about your thoughts. Somebody asked us, do we see a potential for a single regulator for digital assets after entities have self-assessed initially, which I think is probably a good idea, but single regulator or more of the functional regulation that we see on the traditional finance side? Suzanne, you want to start? You're at the top of my box on my screen. So,
yeah, sure. So I think it's possible that we'll see a single regulator, but I want to be careful in what we actually think that means. So when you think about the SEC, right, they are clearly the single regulator for securities, but yet anybody who spent any time in a large financial institution knows that every regulator on the planet still thinks that they have some say in how that organization runs itself. And so, I think in a perfect world, there would be a primary point of contact for regulation around digital assets. Whether that will ultimately be the CFTC or some new regulator that eventually is created. And again, I think I mentioned before, I think in this current political/legislative environment, the likelihood of them creating yet another regulatory body doesn't seem that high. But, never say never. Who knows what could happen? The way I think about it is, like, let's just say it ends up being the CFTC who's going to sort of own the rule book, for lack of a better word, around digital assets. Every time a digital asset also could be a security, you're still going to have to talk to the SEC and you're still going to have to register your right. Like, that is unlikely to change. And similarly, as we start to think about, like, some of the larger financial institutions who are also banks, and who are also investment advisors, and like all of those regulatory schemes are still going to be there, as well as all the state regulatory schemes. Like, that's not going to go away. And so I hope that there will be eventually an organization that emerges as kind of the leader in the space. And maybe that will be an SRO first, before it's really even a federal regulator. But to me, it's hard to imagine where just like anything that has to do with digital assets only ever goes under the jurisdiction of one regulatory or government body. That seems way too optimistic for everything I've ever seen in the financial services regulatory space.
And it could also have some unintended consequences, right? Because something could be a digital asset, but it's nothing like cryptocurrency, and you could then be having all of these very different assets jammed together under a regulator who might not be able to have a handle on all of them. Gabby, I know you probably have a view on this, and then we'll let Caitlin have a last say, and then we'll let these nice people who chimed in with us for an hour, we'll let them go back to their day. But
Sure. So, I've, worked in 50 different countries and helped to do design of legal and regulatory frameworks, right? And so when you look at that, I think Suzanne makes a really important point. You have to look at the social, economic, political, and financial sector realities of the jurisdiction that you're working with. What is it that's going to solve your problem pragmatically, and also help to encourage innovation and economic growth and development, okay, while maintaining protection of consumers and market integrity? When you balance all that together, I don't know if a new regulator through government makes a lot of sense. It takes a very long time to set these up. And in some of the best situations, a formal governance institution like that takes 7 to 10 years to reach that first stage, I would say, of maturity. Okay. It would be far outpaced by the growth of the industry and the evolution of this space. So I don't know if that's a realistic option. You also have a multiplicity of regulators that already engage here. And really what's needed is some sort of a triage system. And that's where I think when you look at this, something that allows for that growth, that's sort of that first point of entry that helps to facilitate, both the evolution that will be needed in existing regulators, as well as to, I think, solve some of the pain points that we see throughout the industry. That's where the concept of an SRO very naturally lends itself to this. And, for those who question, you have to look at the fact that when you look at other countries that have gone through similar stages of transformation, self-regulation usually precedes regulation because it allows for you to kind of tailor and to play and to engage in a way that as the industry matures, you can then create that hardwired regulatory framework, because that, especially in this instance, takes 2 to 3 years at a minimum to pass through legislation. And then at the end, you may not even get what you want. So the better alternative would be to allow for industry to step forward, to be able to leverage the expertise and nearness, and to create a system that truly works for the industry, as well as most effectively and efficiently fulfilling those two dual mandates of consumer protection and market integrity.
Caitlin, any views on the chance or the feasibility or the benefit of a single regulator for this ecosystem?
Selfishly, I'd love to say yes, because when I was a chief compliance officer, going through, a million different types of exams from different regulators was not fun. Realistically, I agree with everything that was said so far. I don't think it's going to happen. And for some of it is for very good reason. There is, a separation of powers that does need to happen. So I know we're over time already, so I won't go on much further than that, because I think Suzanne and Gabby were so eloquent in how they put it. But selfishly, I would love it. Realistically, I don't think it's going to happen.
Listen, this has been so much fun for me. Thank you so much for joining and all of your wonderful insights. And I hope you in the audience who were listening had as much fun as we had on this webinar. And I'm sure there'll be, since something happens every day, there'll be a lot to talk about probably sooner than we even realize. But I'd like to thank you all for joining us. I have to get my notes here. This recording will be available for replay. It will be sent to you at some point in the next couple of days. So you can get your popcorn and listen to us all over again. But anyway, thank you all so very much. And I look forward to seeing all of you soon. Bye.
Thank you.
Bye. Thank you.